selling options for consistent monthly income. Now, I would be honest that it was a big learning curve. First few years were not very good because I was obviously learning the strategies. And then when things started to make more sense, I got a better handle on my strategies, on risk management, very, very important risk management and trade management and all of that mechanical stuff. And that's when I started seeing some results. So the idea here is to show everybody how and when and where we sell options, how do we decide which strikes to pick, how do we basically figure out the whole trade at entry and then at management, and if things go against us, what do we actually do? What's the risk management process that we go through? And if you have any questions in the middle of the webinar, just let me know. My job is to provide you a lot of value here, immense value on one strategy, because I know there are so many strategies out there. It's kind of like overwhelming sometimes to learn and go through and focus on so many different strategies without mastering one. So the idea is to give you one profitable, highly probable strategy that we have been running on our side, and just to show you how we do it and help everybody to get on this path towards managing monthly income with a limited amount of capital that everybody has. Even in my account, I have a limited amount of capital. And on the capital side, I do get a lot of questions. 3,000 to 5,000 is a good range to start with to get your feet wet in this option selling space. And from there on, you can just increase your number of contracts, taking a little bit more risk. But that's where we suggest that people start when they come into our program. So why do we sell options? Most of the options that are out there, the listed options, they expire worthless. That's what the research says. That's what we've noticed. That's what we have, felt in the market. And therefore, we believe, and the math backs it up, that selling options make a lot more sense, even though the per trade P&L is slightly smaller than the buying side, but you get more win rates. You make more money by doing a lot of trades incrementally on the sell side. And that is the reason why we sell options. I used to buy options. I used to wipe out my account often. But as soon as I moved on to selling options, things really changed dramatically because I went onto the other side of things, meaning 40% to 50% of options expire worthless. So the other side is, this number is slightly higher. The actual number is slightly higher, but I was being a little bit more conservative here. The actual numbers are at 60 to 70% that expire worthless. And therefore, when you sell those options, you have that 70% probability of making money. We have 3 simple rules of selling options. The first one is trade high IV regimes and underlyings, tickers that have high implied volatility, because that's where the juice is. The premium is juicier when you sell into the high implied volatility. The other thing we look at, we only trade liquid underlyings, because when the trades go against you, you have to manage those trades, meaning you have to go in and out of those trades often, and you have to have a liquid marketplace for those options or for those underlyings to be able to do that successfully. Otherwise, we will give up on slippage. We will give up on a lot of wide bid-ask spreads. Bid-ask spreads of these options is where the risk is, and that's where the market makers make money. The third and very important piece is we trade very, very small amounts, like 1 or 2 contracts max on each entry. Then when we see opportunity, we increase the contract size, but we always start very small based on our portfolio risk budget. Otherwise, there's a lot of risk into the account, into the portfolio, and concentrated into small position sizes or a small number of tickers, which we don't like. We like to spread out the risk, uncorrelated assets across the portfolio. Why am I just showing you one strategy and then on the other side I have 3 or 4 more? Because it's easy to grasp the mechanics of one strategy at a time. In a 1-hour webinar, I cannot give you 5 or 6 strategies to take home with. We do trade 4 or 5 most favorite ones that we have more often, and all of them are defined risk. So we don't trade undefined risk strategies, meaning you don't have unlimited risk in your positions. When you go to bed at night, you know exactly how much money you will make and how much money you can lose on those trades and what to do when those trades actually go bad or go wrong. So therefore, it's a low stress process, defined risk, and we make small increments of contracts. We make small P&L on each trade, and then we play the law of numbers, which is the more trades you do, the better your returns are, the better your P&L is. So how do we select the strikes? Now, I will show this to you on the platform. I will go live on the platform as well to set up the strategy. But here's the theory behind it. We select 16 to 20 delta. What does that mean? Delta means if I select 16 to 20, I have the opposite of it to make money. So I have an 84% chance, from 80 to 84% probability of making money in that trade. That's where we sell the options. This is a short put spread, so we buy one below it. We sell at 16 to 20, we buy at 12 to 13 delta. And then we sit on the trade, we let it decay on us, and then we let theta decay work for us. That's the whole idea of selling options, because we don't panic. I will show you my live trades in my portfolio. It's a live portfolio real time, where I've taken 2 trades recently in high volatility environment, one on oil and one on S&P 500. Both are not doing great right now, obviously, because the markets are very volatile. But because the opportunity was there, I went ahead and sold those options. And then the idea is like, not touch them, just let them decay, touch them when it goes really bad on you, and make P&L recently. On my YouTube channel, you will see a lot of videos. I post a lot of my videos, almost all of my live trades on my YouTube channel, where I show exactly how I trade, and then P&L, how does that come in? So even if the P&L is a negative one, I show it on my YouTube videos. Most of them are positive trades, so you can check out my YouTube channel and see how we actually trade these strategies. Another thing on selling options. So if you do a mean return of any underlying asset throughout the universe, the mean return of that asset will fall within one standard deviation. Okay, 70% of the time. So that's the idea. 70% of the time, the underlying price will be within a one standard deviation of its mean return. What does that mean? One standard deviation means the risk is basically 68, 70% of the time, it will stay within this range, and everywhere else is the tail risk. 95% of the time, it will stay within 2 standard deviation. And you don't need to worry about calculating these standard deviations, because the platform actually does it for you. So I will show you exactly what the standard deviation means. It means the risk of the option, of the strategy, of the underlying asset, of the strike. If you go 3 standard deviation wide, 99% of the time, the price will fall within this range. But we don't go that far out, because then we don't collect enough money. When I say enough money, that means we have to collect enough P&L or enough premium for the risk that we are putting down to initiate the strategy. Risk reward is also a very big metric for us. We don't trade when the premium is too small and the risk is too high. We have to find a sweet spot between the two. We go into the trade when the P&L or the premium actually makes sense to us. So that's the bell curve normal distribution I showed you. This is just in theory. We sell outside of this one standard deviation, and we collect 84% probability or chance of winning on our side. And then we let the trade sit on it. We let theta decay work for us. We let short volatility work for us. If it's higher in implied volatility, we let IV decay to work in our favor. And I'll show you exactly what these Greeks mean when I take you to the platform. But higher IV actually means wider expected moves and safer strikes, meaning you go further out. And I'll show you on the oil trade that I did. The further out you go, the less chances are that you will lose in that trade, because the less chances there are of that underlying asset moving too far out from where you start the trade. You can read all of this in your free time, but this is just a theoretical move on what does standard deviation actually means. Okay, so this is the actual strategy. First in theory, and then I'll take you on the platform, and then I'll show you in practice as well. So we sell a put at a higher strike, and then we buy another put at a lower strike. That's a bull put spread. We collect a premium. It's a net credit trade, because you're selling a higher expensive option and you're buying a cheaper option. For that reason, it's a net credit trade. And that net credit is actually your max profit. The risk is basically your spread width, meaning your spread. So your short strike and your long strike, what is the spread between that? If the spread is $10, then you minus the credit, that's your max loss. And the directional bias in this, we actually don't trade any directional bias. We trade the market, meaning wherever the price action is. So if the market is down, we will sell put options. We will sell put spreads. If the market is up, we will sell call spreads. And that's exactly what I'm going to show you with my live trades. The oil trade, because the market jumped up after everything that's going on in the world, I sold the call side, because the premium was juicier on the call side. And on the S&P 500, because it dropped, I sold the put side. This is called selling on the strength of the market, meaning we sell into the move of the market. If the market is down, the juicier premium is on the put side, because people are now panicking. But the good thing about this is, as a contrarian trader, this is called contrarian trading, is that, you collect more premium, you collect more credit, your risk and reward actually makes more sense. And again, I'll show you exactly what it means. On the platform, it will make more sense. Anyway, this is the P&L payoff diagram of a bull put spread strategy. You see here, we sell, let me take out the marker. You sell a put strike here, and you buy a put strike here. Your break even is basically your put strike minus the credit you collect. That's your break even point. And anything here beyond this, your long strike, is basically your max loss. Again, we don't go towards max loss. This is a simple setup, very easy to manage, very easy to trade, easy to understand for a new beginner trader or an intermediate trader. We don't call ourselves advanced traders. We are getting there. But again, we do a lot of deep research on our platform. I'll show you exactly what we have done recently. to understand more about these option prices, how they are built, and how they behave in different IV regimes. Okay. For now, this is what you need to know. So this is where we are thinking about selling a bull put spread where we collect a net premium. Okay. Next one, what do we look at on the platform? Now, again, I will take you there and I'll show you everything. There are some important things that we look at. Again, delta is the most important thing. Like I mentioned, we sell between this line, 16 to 20. Our sweet spot is 17, 16, somewhere around that mark. The other thing we look at is, you probably cannot read it. This is implied volatility. And these two are also the very most important things, which are volume and open interest. So how do we determine liquidity in these assets? OI, which is open interest, is what we call volume and liquidity factors in options. Volume is basically how many contracts are being traded off each underlying strike or an underlying asset every day. Open interest is basically how many contracts are actually open at that strike level. Again, I'll show you on the platform, but this is the picture I thought probably is better to understand. So here's the thing. We look at open interest, we look at volume, we look at delta, theta. This is basically my setup. This is my live setup from the account. You will see it in my live account as well. I have bid ask here, delta, theta, open interest, and volume, and I have implied volatility. Okay, these are the only things I need. I don't need anything else. If I do, I just add it from here. There's an option to add it from here, but to be honest, most of the time I don't actually need it. So this is the volume and open interest that we look at. Next is S&P 500 E-mini futures. Okay, so why do we trade futures options? A couple of things. Again, this will make more sense when we go on the platform and look at it. But for now, the way I can explain this futures options versus everything else is capital efficiency is the best thing. Liquidity is always there, especially in the main indices, main products like S&P 500, NASDAQ, and all of them. But futures options, main thing is the reason we trade these more often than anything else, other than if you're doing 0DTE options at that point, or for those, we trade SPX, NASDAQ, and those are the two main ones. We trade index options. But for everything else, we trade futures options. I don't really touch single stock or ETF options, even though they all work the same way. The capital efficiency is actually in the futures options market. And I will show you that on the screen once we get there. When to use this strategy? Again, when the IV rank is high, like it is right now. Your outlook for the market is neutral to bullish. Again, like I said, we trade, we don't really look at the direction of the market. We're not directional traders. We make money whether the market moves or does not move. That's how our strategies work. And the main important thing for us is to be selling in high IV environment and choosing liquid underlines. Okay, those are the main things. What if something goes wrong with your bull put spread that you put on? If there are more than 30 days left, this is how we manage the trade. We convert it into an iron condor. I have a perfect example for you on my trading platform. I'll show you that. If it's less 30 days, we roll it to collect more credit into the next cycle. Simple stuff, easy to understand. It keeps you in the game, and you get more and more premium when you go out in the back month cycles. You collect more premium, you expand your break evens, and you stay in the game. We don't go all in. We have a trade size limit, which is 2 to 5% of our account for each trade. Now remember that, 2 to 5% on each trade. When I say that, I mean when you're trading S&P 500, it should not be more than 2 to 5% of your account for each trade that you are in. Here's an allocation example. This is what we follow. I suggest you do look at this. If it makes sense, follow this. If it's a small account, this is where we live most of the time. 5% to 4% to even 3%. Okay. This is where we live. Our account is about 5.5%, and we live within this range. So 3 to 5% is where we live. We don't put too much risk in each underlying, in each correlated risk. We don't put correlated risk. When I say correlated, I mean you're trading E-mini S&P 500 futures options, and then you're also trading SPY ETF, and you're also trading SPX index. So those are exactly the same products, just built differently. So we try not to do that. Again, just to give you the offer here, like I said, if I don't follow on my previous offer, you don't have to look at this. But if you join the challenge, there's a 4-month support available in our Discord channel. So we have a Discord community. You will be part of that. I will try and answer all your questions. Whatever I left over, my team will answer it. And there is a monthly Q&A on all your questions, so you will not be left behind. This is the link. I will drop this link in the chat as well, in case if you want to look at the page and decide whatever you want to do. But in the meantime, we will go on the platform and I will start showing you the actual trade stuff. And by the way, this is our blog site. We have a lot of strategies, plus we have back testing strategies. So this is real data. We have a database of real option prices on SPY and other tickers. We had just started doing all these deep dive research into all of these strategies. When implied, if I was to take one thing away from here, this was done on trailing 30-day realized volatility. IV exceeded forward realized volatility 87% of the time. So what does that mean? Market panics, IV jumps up. That's when you sell options. It is always overstated. IV is overstated by this much on average in the last 3 years. We ran it for 3 years. Now we have 6 years of data. When we did this research, we had 3 years of data. Now we have 6. Okay. We did it on the 30-day options because that's what was available. We were trying to match it with VIX, and VIX is like a 30-day thingy. So we did it on 30 days. Premium strongest in the low regime, you have a good spread as well. In high volatility environments, you have an 87, 83% win rate. But the main thing here is the spread. The IV is always higher than realized volatility, and therefore you will sell IV whenever it pops up. Okay. Other things to take away from this research. What happened? We looked at 776 days, and our net result was that obviously whenever the IV jumps, you have to collect that premium because that's when you make most of the money. Okay. You can go through all of these. The mean spread is $3.64 on 30-day average. We look at the first 2 rows, not the others, because those are other metrics, but look at these first 2 rows. Mean IV spread 3.64%. Last 3 years. If you do it for longer period, it will be higher. We are going to do more longer period research into all these buckets. What else can I show you? Win rate. So when IV is 20, your win rate is 85. IV slightly lower, your days to expiration actually comes down from 45. We sell at 45 days. It comes down to like 30, 35 days. And the win rate is always higher when you sell into high IV. That's the key part here. I don't want to take too much of your time here, but look at our blog. We have a lot of strategies covered. We are covering more and more. We are doing probably posting 1 or 2 blog articles each week. Another thing, we are building the tool that everyone needs. I wish I had this when I was starting. It doesn't have live data yet, but this is the theory behind it. So the tool will actually help you build your portfolio. So you'll add your positions, whatever entry price you had, and whatever, it will give you the allocation. Then on the analytics tab, it will give you your total return from whenever you started, whatever your base portfolio is. Here's the 5-year plan. We will start with the basics. I will exactly show you how things work in the options market, payoff diagrams and everything. Then we get into the real stuff, which is straight away, we put the trades on. Okay. It won't be live because the markets will be closed, but we will sell the trades based on our mechanics, how we do it. Cash secured puts, covered calls, credit spreads, and iron condors. Again, our favorite ones here are credit spreads. And finally, the zero DTEs. We trade a lot of zero DTEs in the index option space, and that's what we are going to teach and show you. Now, another big thing, you can read a little bit about me, there's 100% money back. If you don't like it, just email us. You will find the contact us here, contact. So just email us. Thank you, and I will hope to see you next time. Bye-bye, everyone.